A real estate investment trust, or REIT, is a company that owns, operates, or finances income-producing real estate. It's an easy way for everyday investors to invest in real estate without having to buy, manage, or maintain physical properties. Think of it like buying stock in a company, but instead of selling products or services, the company owns properties that generate rental income. Here's how it works. When you invest in a REIT, you're essentially buying shares of a company that owns real estate. This could be apartment buildings, office spaces, shopping malls, hotels, or even hospitals and storage units. These properties generate rental income, and the REIT is required by law to distribute at least 90% of that income back to investors in the form of dividends. That's why REITs are so popular among investors looking for steady income. There are two main types of REITs: equity REITs and mortgage REITs. Equity REITs are the most common. They own and manage physical properties, collecting rent from tenants and distributing profits to investors. Mortgage REITs, or MREITs, don't own properties but instead invest in real estate loans and mortgages, making money from interest payments. Let's look at a simple example. Imagine a REIT that owns a portfolio of 50 apartment buildings. The tenants pay rent every month, and the REIT collects that income. After covering maintenance costs, property taxes, and other expenses, the REIT distributes most of the profits to investors. If you own shares in this REIT, you'll receive a portion of those profits as dividends, just like how stockholders receive dividends from a regular company. One big advantage of REITs is accessibility. Instead of needing thousands or even millions of dollars to buy a property, you can invest in real estate with just a few $100s by purchasing REIT shares. They're also highly liquid, meaning you can buy and sell shares on the stock market, unlike physical real estate, which can take months or even years to sell. However, there are risks. Since REITs depend on real estate markets, their value can go up or down based on economic conditions, interest rates, and demand for properties. For example, during a recession, property values and rental income may decrease, which can impact REIT dividends. There are also different ways to invest in REITs. You can buy publicly traded REITs, which are listed on stock exchanges like the NYSE, making them easy to buy and sell. There are also non-traded REITs, which aren't on the stock market but can still offer returns. However, these can be harder to sell and often come with higher fees.